Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, July 21, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And what you'll see today is pretty simple. We had mainly a flat day for the most part, while the SPY was down 30 cents and the S&P 500 or the SPX, the cash index, was down less than 1 point. That classifies as a flat day. The other indexes were down slightly. We'll get to those in a minute. We had the Dow down 31 points and the NASDAQ down a couple of points. So basically it was the common and normal variety of Friday light volume float around for most of the day. There was a little bit of activity in the morning. The market took a little bit of dip, but then climbed back up close to the flat line near the end of the day. That's normal for a Friday. We get very light volume, especially in the summertime. We're in the middle of the summer doldrums, so you can't expect a lot of trading activity and a lot of volume on Friday. That's just typically the way it works. There was a pickup in volume today, but that can be attributed to the expiration of options, and that's typically what happens. So we did see about 85 million shares traded in the Spider today, but most of that is attributed to options expiration. Looking at the bigger picture, there's nothing wrong with the Spider. We're still in an uptrend, or I should say there's nothing wrong with the S&P. We're still in an uptrend above the moving averages, above pretty much everything, almost and very close to the all-time highs. And this is, and you know what, I want to back up a second because I got a very important question, which was a good question from one of the members. And the question was, and this is talking about the cycle that I'm expecting to take hold, meaning a cycle top, and I'm expecting a corrective pattern to begin or a corrective phase to begin in the market anytime between now and the first part of August, let's say. And the question was, how do you know if the cycle's not going to play out? And that's a great question. And the answer is that if I've identified a window of opportunity for the cycle to top out, and let's say that window was really from middle of July until, we'll just say, around the middle of August to be fair. So we'll give it a 4-week span of time. If we get into the middle of August and we're still continuing higher, and there's nothing wrong with the market, and we continue to trade very bullish, then I'm going to have to say that the cycle's not going to play out, and therefore it just passed, and it is what it is. It's not common. It's not necessarily likely, although it is possible. It's happened before, but under normal circumstances, my expectation is that we're going to see the cycle take hold. We're trading up into a cycle high, and therefore what happens during these times is it never looks like the cycle's going to play out. It never looks like when the market is bullish, for example, and the behavior is bullish, the sentiment is bullish, the market technically looks bullish. It never looks like it's actually going to turn. What happens is you'll get one of a couple of things happening. You'll wake up one morning and there'll be something that happened overnight, whether it's in Europe or Asia or somewhere else, and that'll send a spark to the market and potentially begin a down phase. And under those conditions, we're looking for a specific thing to happen in the market. We're looking for a signal of a top. We're looking for at minimum of a doji candle. We're looking for a reversal candle. We're looking for a gap and crap where the market gaps higher one morning and finishes on the low for the day. That puts in a reversal candle. It's called a gap and crap. We're looking for any combination of those things to take hold, and it all can happen in one specific day, which will ultimately change the character of the market and generally send us into a corrective phase that should last for at least a couple of months. Now, if it doesn't happen, I'm happy to say I'm wrong. It is what it is. What I do is go off the information that I have that served me well over the years, and I'm going to go with that information and the indications that I have until proven wrong. I'm happy for the sentiment to get more bullish. I'm happy for the market to even go up a little more, because the more they suck in the unassuming and individual investor, the more the sentiment becomes bullish, the less buyers there are available to buy the market or buy individual equities. Therefore, when there's no one left to buy, what's the other option? Well, the other option is when things get to a bullish extreme, generally speaking, you're going to see a turn in the other direction. That generally happens at extremes. It's just a matter of how extreme is the extreme going to get. Net, nothing wrong with the market right now. We're waiting for the signal, and that's part and parcel to why I kept telling you, I kept saying and repeating over and over again that nobody should be taking a short position in the market until we get the signal. We need the signal in order to confirm that the cycle is topping out. I've said this time and time again, the market can go in either direction a lot farther than most people recognize or want to believe most of the time. Looking over at the IWM, it's interesting because the IWM today was the lone ranger on the downside, being down any meaningful percentage, being down 0.5%, 72 cents in the IWM. So everything else was pretty close to the flat line, although the IWM was down. And if you remember the last several days, we had the transports down. We'll get to those in a minute. So, whether or not this is meaningful remains to be seen up into next week. However, with the transports being the potential canary in the coal mine, we talked about that the last couple of days, and now the IWM showing weakness today, that has me paying very, very close attention to those two, and they are my favorite leading indicators of the market. From a technical perspective, there's nothing wrong with the IWM. We're in the upper range. We're not at new highs today. We were at new highs yesterday, but there's really nothing wrong. One down day doesn't make a trend, doesn't create a trend. I'm just watching very closely because it is my favorite leading indicator. So every slight move, I pay very close attention. If the move becomes more meaningful, then we'll obviously discuss it here, and maybe it will become more meaningful to the other components or the other indices across the market. We're going to look at the VIX again tonight, and you can see here the VIX is at new recent lows. And what's interesting about that is, and I'll say it time and time again, anytime we get below 10, and now we're approaching the 9 handle, we're in the 9 handles, but we're approaching 9 even, and potentially even get below that, that's an area where you want to consider taking a look at volatility, because the lower the volatility gets, the more closer we are to the volatility changing direction. That's just the way it works. You can see what happens each and every time volatility spikes up, we back off. Every time we get down in this zone here, we take a spike up. We haven't taken a spike up any meaningful manner in a couple of weeks, but look what just happened just in the beginning of July. This is July 6th. The VIX was at a high of $13. Now we're at 9. That's quite a move. So the VIX can move very quickly before you know it. So anytime the VIX gets down in this zone, anybody interested in being long volatility should take a hard look at the VIX down in this area. So I put a little line where we are today, today's low. Let's go over to the weekly chart and we'll see what happens. You see how we are at lows in the VIX. How long are we going to stay at these lows? Well, that remains to be seen, but my indication, my history, my experience tells me we're not going to stay down here for very long. And the issue is, and I talked about this last night, it's very difficult to take a position in something like the VIX when volatility is non-existent, the market's at highs, the VIX is at lows, going lower. It's very difficult to what should be doing the right thing at the right time. It's very difficult to wrap our head around it. It doesn't feel very good up until the point in which it turns around. But this is the time when the opportunity presents itself, even if it doesn't feel good at the time. It is the right move, but you have to give yourself time. It may not necessarily turn around next week. It may not turn around over the next 2 weeks. But 2 months from now, I don't think we're going to find the VIX continue to being down this low where we are today. I think we'll have spiked up by that time. Looking over at the transports, we had a slight down day in the transports, being down 12 points. It's a green candle because we were lower, opened lower, and then we traded higher from the low or from the open. That's why it shows a green candle. But it was another down day in the transports. And again, as the leading indicator, I have to pay very close attention to the transports because it is a leading indicator of the market, and it doesn't necessarily have to be an indicator of tomorrow's market, but it is generally a leading indicator. And now we've seen a pretty decent sell-off from the highs in the transports, and with the other markets at highs, it's very interesting which one's going to win out. Is the transports going to just turn around and trade higher, which is certainly possible, or is this a signal of more to come? We don't know yet, but we're certainly bound to find out in short order. Next week should be very important. There's a whole host of earnings coming out from Dow and S&P related companies next week. So if volatility is going to enter back into this market, it's certainly got a chance to happen next week. There are dozens of S&P and Dow related companies reporting earnings next week. So therefore, it should get a little bit more exciting than it was this week. And for an options expiration week, it certainly was rather dull. I didn't necessarily expect that, but as we know, the market doesn't do what we expect it to do. It does what it does, and the market is right 100% of the time. When I look over at the weekly chart of the transports, what I see is a pretty solid down week. I consider this a reversal week, and we'll see what happens. We'll see how it plays out over the next week or two. Obviously, the market still remains technically bullish, above all the moving averages, near the highs. But with a down week like this, with the market not showing the same type of visual on the chart, meaning the S&P or any of the other markets, we have to pay very close attention. We just have to recognize in this bull market, each and every time we had a down week about of the same magnitude as we just had a quick turnaround and the market went back up. So we'll see what happens next week. It will be a very important week for the markets, specifically as it relates to the transports, to see if, in fact, the transports were a canary in the coal mine this week. Another puzzle piece that we like to look at is the XBD, or the broker-dealer index. And we know, and I've said many, many times, that without the financials, the market can't rally, and also the market is unlikely to sell off if the financials are strong. And when you look at the XBD, or we look at the XLF, and we can look at the chart of the XLF, and you see here that the XLF on the daily chart is just going sideways above the moving averages. This is a bullish pattern. So if the financials, in fact, have another up leg coming, it's unlikely we're going to see any crack in the market at this time. Without the financials going down, it's unlikely the market goes down. And on the flip side, obviously the market would have a difficult time going higher if the financials were going in the other direction. So the financials are very important. The transports are very important. The IWM is very important. And so we have some divergences developing, and I'm watching very, very closely. We're looking for evidence one way or the other of the next major move in the market. Here's another, what usually is a leading indicator, which is the Philadelphia Semiconductor Index, or the SOX. Now, when you look at the SOX, this tells a little bit of a different story. We had a pretty big sell-off in the SOX all the way back on the 9th of June. We had a bearish pattern that played out to the downside, found support at prior consolidation, prior pivots over here. This was a very obvious, to some of you anyway, a very obvious level of support. Here's a scene of the crime breakout. So we came back in to test the former breakout or scene of the crime area. Now, look what we have here. We have a big down move. We had some consolidation and another bearish pattern play out, another down move, and that played out. Now we're rallying again. However, we're not at new highs in the SOX. So this is showing a different picture than some of the other indices or indexes that we look at. And the question is are the SOX telling a different story? When you look at the weekly chart, we did put in a tail candle on the weekly. We sold off a little bit. We're rallying back, but we're nowhere near the highs. Well, I guess we're close to the highs, but we're not at the highs. And the question is, are we going to fail again here? And if we do, then this index is going to come down. Right now, we're above the moving averages. There's spacing in between the moving averages, which is generally or always positive for the market until we break the moving averages. So when you see the moving averages go parallel, that's a sign of a bullish market. So right now, the market from a long-term perspective is bullish, but when I look at the daily chart of the stocks, I have to just see, or I can't help but see, that this big large down candle or this big large down day was a canary in the coal mine, and until and unless we can close above that level on a daily chart, then this market is still susceptible to a sell-off, and until we close above this high from the 9th of June, then technically this is really a bearish pattern. So I'm watching this also very closely. Looking over at the gold market, gold is doing, for the most part, what we indicated last night, which is trying to get up to the $1,260 level, potentially even a little higher, but I think we'll stall out there. There's a ton of resistance, also called overhead resistance, in this zone. You see all this chart consolidation, more chart consolidation. You have some pivots over here. So we have pivot high here. We have a red candle high. That's going to be a little bit difficult for the gold market to get through. So right around that 1260 area is the next major level of resistance that I see for the gold market. Today also marks the 10th day up since we made a bottom down here in the gold market. And generally speaking, 10 days is usually an important number. You know, I like 7s, I like 10s, and doesn't have to happen. However, when I see something like this and I see a 10th day with what could be termed as at least the look of an exhaustion move, it's a large up day in comparison to the rest of the days for the most part since the bottom that was made down here around 1200. I think it was 1204 to be exact. When we see a large up candle like this, I would have liked to see it on bigger volume. If we saw it on bigger volume and it traded up into that 1260 zone, and that's where we finished the day, I would say that would be an exhaustion move, and I would be looking for a corrective phase to begin to the downside. But we didn't necessarily see the volume today, so therefore I'm not going to call it an exhaustion move. However, 10 days up in a row with one little small red day in the middle there, that tells me that gold is overextended in the short term and probably needs to consolidate for a while at the minimum. But we did fight, or gold fought, to get above all the moving averages. Therefore, it is somewhat bullish, but we are running into what will be a lot of overhead resistance. Silver, same routine, very similarly looking chart to gold. We're running up into this red candle high that comes in at 16,645, and also the 50-period moving average comes in slightly above that. Again, up here, a lot of overhead resistance. We are extended on the daily chart, therefore, most likely we'll need to pull back at some point in the near term. There are a couple of more reasons why, and just looking at the silver chart, we can state that we should run into a fair amount of resistance. When I look at the retracement levels, and I look at, for example, pivot high up here, okay, to pivot low, all right, this is about a 50% retrace right here. That's what we hit today. When I take this pivot high against the same pivot low, their 382 is slightly above where we are now, and you have the 50-period moving average right above that. So we could see a little bit more of a push higher at that point. My expectation is that we'll pull back in silver. We should find overhead resistance slightly higher than we are now, if not right where we are now. Over in the crude oil complex, what I do find interesting, and you can see we had a pretty decent down day today, being down almost 3% in crude oil, trading right back to the 20-period moving average, which is the red sloping trend line. But what happened yesterday was we completed the ABC corrective pattern that completed over the top of the A leg that was found over here. And then what happened the next day? We traded down almost 3%. It's pretty interesting how that happens. I don't think it's an accident. There are no coincidences. In my book, and the way I look at it, we completed a pattern, and upon completion of the pattern, we had a sell day. And that's just the way it works more often than not. The question is this just a pullback and we go higher next week, or are we going to have a more meaningful correction in the crude oil market? Time will tell into next week, but if you look at this trend line I just put on, if we come down a little bit farther, I think we'll find support at that trend line. Also, what's quite interesting is if we came into that trend line, even pierced through it slightly by a little bit, that would represent, ironically enough, this pivot low to this pivot high, and the 50% retrace comes in right around $45. And I find it interesting that that coincides with this upsloping trend line. So at that point, for any intraday traders that want to take a crack at crude oil, that would be an area that would be interesting around the 45 or maybe a pierce through $45 a barrel. You should get a bounce from that level based on A, the retracement of 50%, and B, the trend line that's upsloping, connecting the pivot low, and then here we have the potential for the market to trade into that area next week. Be interesting to see how that works out. Looking over at the bond market, look at this. The bond market popped over the upsloping trend line today after fighting it for 3 days. Today we got above it, and we'll see if we can maintain above it next week. In order to have solid confirmation that we're going to trade higher once again, we really need to close above today's high on Monday, for example, and that would take this bearish pattern off the table in my book. And let me clarify, the pattern being the trend line, this upsloping trend line that was containing the market for the last several days, that would be off the table if we can close above today's high on Monday. We'll see if that happens. I'm going to leave the line on the chart to see where we stand. But again, keep in mind, this isn't necessarily a lesson in the bond market. This is a lesson in chart patterns, if you will, and trend lines, more so trend lines, and how they act and react, and how the market respects the trend lines or simply just disregards them. And if we have a failed bearish pattern, for example, and this, in my book, was a bearish pattern, right? We had a down move. We're going sideways. And generally speaking, it promotes another down move. Now, that could still happen regardless of whether or not we get above this trend line. But in fine-tuning the concept and fine-tuning the conversation, I think this trend line is important. And I think if we break above this trend line in a more meaningful manner, I think that we'll trade higher and go back to challenge these highs once again. We'll see what happens. We'll see how that plays out into next week. And keep in mind, we have already retraced 50% of the move from this pivot high, this pivot low. 50% comes right about here from an eyeballs perspective. I could be off by a little bit. It's probably more like up here. However, the 618 would make it right about here. So we're coming into the 618, and we'll see. There could be or is a possibility that we just trade up into that area and then fail once again. We'll see. Jury's still out on the bond market. We'll see what happens into next week. And the dollar, long and wrong in the dollar, we came into or are still coming into the area I cited the last couple of days. I want to go over to the weekly chart, and I want to show you that. Look where we are. I'm going to draw a line in just to see where we are relative to the prior pivots. Okay, if I just put this trend line here, look at all this chart support in here, 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 here. Look at all this chart support. Now, we broke down below it, but this turned out to be supportive of the market before another run higher. Here we are again. We have the 200 period moving average slightly below us. We can certainly pierce through and hit that 200, but I have to believe, and I'm going to take this trend channel off the chart because we no longer need it, but I have to believe we're coming into a very, very solid amount of chart support in this zone. When you see this many times or this many pivots that were supportive of the market in this zone, right? We just have all this stuff. And when you look at that, all this chart support in here, market fought this level many, many times. You have to believe that it's going to be supportive of the market once again. Even if we pierce through it, I think that will be it. Even if we tag the 200 period moving average, I think that'll be enough to flush out the weak hands, and that's at the point in which my expectation is we're going to see the dollar reverse at that point. Now, you could say I'm being biased because I'm long and wrong the dollar, and that's fine. I could certainly understand that, and I get the point. However, I'm just looking from a pure technical perspective. All the chart support that we've had around this zone, in this area, so many times, I just have to believe that this is an extremely important price level to the market. That's just generally and more often than not the way it works. And with that, I'm going to leave it here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.